So, model tax conventions, introduction. So, to enable various countries enter into treaties, which are standardized to some extent, the OECD and the UN have developed certain model tax treaties. These treaties can be used by various countries as a starting point in their negotiations with other countries. So, while these models are not legally binding, they have been extensively used by various countries as a reference point or framework while entering into their tax treaties. So, in some cases, countries have made suitable changes in their draft models according to their economic environment, commercial, and tax considerations. So, the model tax conventions are like models or frameworks which we look on to form our own tax treaties. So there are three main model tax treaties which we will focus on or look at, except the third one, which is the US model. That one is outside the scope or beyond the scope of the CITG syllabus. So the various models are the OECD model, the UN model, and the US model. Now, the OECD model emphasizes more on residence-based taxation. So developed countries adopt this model in case of treaties with other developed countries. So it started from 1963 draft convention, then it is followed by a regularly updated or amendments to it. Okay, so it is regularly updated or amended. So currently, the last amendment was in 2017. Okay, so the UN model also emphasizes on source-based taxation, and mostly developed countries adopted this model when they were dealing with developing countries or between two developing countries. So the OECD model convention was used as the main reference document. So you should know that with the UN model, we mostly use it when two developing countries are dealing with each other or when a developed country is dealing with a developing country. Now, the US model is for the USA for all their treaty negotiations. So this model influenced the existing treaty between the countries and the US. So they still use the OECD model as their main reference document. So you could see that the OECD model is the key chief model which you will require in your exam, as all the other models have similarities based on the OECD model. Now, what is the focus of the CIT exam? Now, the CIT exam focuses on the OECD model and the UN model only, since Ghana has no DTA with the United States. But however, more emphasis is placed on the OECD model by your examiner. Now, what are some of the significant differences between the OECD and the UN model? Okay, so you should know that the OECD and the UN models have developed certain treaties which are non legally binding on any country. So the OECD model is essentially a model tax treaty between two developed nations, whereas the UN model is a model treaty between a developed country and a developing country. Furthermore, the OECD advocates the residence principle, and the UN model is a compromise between the source principle and the residence principle, but it gives more weight to the source principle, okay, as against the residence principle. Now, let's look at contents of model tax conventions. Now, model tax conventions have some particular content and we can break it into 7 chapters. So, developing countries around the world also use the OECD model for framing their tax treaties. Today, we'll understand the components forming part of this model convention and how to approach the same. Broadly understanding a model convention will provide a better view of the model treaty. So, first is the scope of the treaty. That's the chapter 1. So, chapter 1 or part 1 of the model treaty is the scope of the agreement. So, it includes 2 articles: the persons covered under the treaty and which income will be covered. Okay. So, article 1 deals with persons covered, and 2 is the the taxes included, which we call the taxes covered. Okay. Then the part 2 or the chapter 2 deals with definitions in the treaty. So, chapter 2 defines the terms commonly used across multiple articles. So words covered explicitly in an article, that is dividend interests, are also included in the relevant articles. So the chapter 2 consists of 3 articles. Article 3 deals with general definitions. Article 4 deals with who residents are. And Article 5 establishes the concept of permanent establishment. And these areas are very likely all the time in your exam. So you should master those areas, especially Article 3, 4, and 5, as you can get up to 40 marks worth in your exam. Then the main body or the main part of the treaty, which is under chapter 3. So the main body of the treaty includes 3 chapters and 19 articles dealing with the taxation of income and capital. So the main body follows 2 categories of rules. Firstly, from Article 6 to 21, it deals with the taxing rights of the state of residence and the state of the source for the different classes of income. So Article 22 does the same for the taxation of capital. So when one contracting state has the exclusive right to tax a category of income, another contracting state will not tax the same income to avoid double taxation. So as a general rule, the proprietary rights to tax the income lies with the state of residence. That is per the OECD model. Now, secondly, when the state of source has the right to impose tax on the same income or capital, the state of residence also have to what? Allow a relief to avoid double taxation. So the state of residence will provide relief either by following the exemption method, which is covered under Article 23A, and through the credit method, which is covered under Article 23B. So you may be given a credit or an exemption, which we discussed earlier. So we can classify the income or capital under 3 classes based upon the taxing rights of the state or the source or situs where it is located. Okay, so usually we classify income based on income that the resident state will tax primarily, or the income that the source state will tax primarily, or an income which the source and the resident state will share the taxing rights. So those are the 3 main ways we can classify income or capital. Now, chapter 4 deals with special provisions, which consist of 7 articles, but usually it is 3 main which are examinable at your level. So special provisions, and each article deals with specific concerns. So like Article 24 deals with elimination of discrimination in various circumstances. And we have Article 25, which deals with the establishment of mutual agreement procedures. Article 26 dealing with exchange of information. 27 dealing with procedure for assistance in the collection of taxes. 28 dealing with the tax treatment for the members of diplomatic missions and consular posts. 29 dealing with the entitlement of treaty benefits. Then 30 dealing with territorial extension of the convention. But 24, 25, 26 are the most examinable in your CIT exam. Now, the final provisions and the fifth part, and these final provisions of the model convention have 1 chapter consisting of 2 articles. Article 31, which states the date of enforcement of the treaty among the contracting states, and 32, stating the date of termination. Now, let's look at the OECD and the UN model contents and their differences. Now, we have the chapter 1, which talks about the scope of the convention. So it has the persons covered and taxes covered, all the same between US and OECD model. Then chapter 2 definitions, we have article 3, general definitions for residents. 5, permanent establishment. Then chapter 3 talks about the taxation of income. We have income from immovable property, same as the OECD and the UN. Then business profit, same. Then article 8 is international shipping and air transport under the OECD model. But under the UN model, it is international shipping and air transport under alternative A and B. So there are 2 alternatives under the UN model. Then article 9 is the same. Then we have article 10, dividends, the same. Then we have interest, which is same, royalties, and Article 12. But Article 12A is introduced under the UN model, which covers fees for technical services. Then we have capital gains for Article 13. Then Article 14, under the UN model, it is known as independent personal services. This has been deleted by the OECD model as independent personal services are treated as business profits or business income. Now we have income from employment, or under the UN model, it is known as dependent personal services. Then we have directors' fees, which are known as directors' fees and remuneration for top level managerial officials under the UN model. Then we have 70, which talks about entertainers and sports persons. But under the UN model, artists and sports persons, then we have pensions. And under the UN model is pension and social security payment. Then we have government service for 19. Article 20 talks about student, 21 talks about other income. And we could have special provisions like teachers and professors or visiting lecturers. Then we have taxation of capital. Then Article 23A, 23B still talks about the exemption and credit method under both conventions. Then we have special provisions, which talks about non-discrimination, mutual agreement procedures, exchange of information, assistance in collection of taxes, members of diplomatic missions and consular posts, entitlement to benefits, and territorial extension. But you realize that under the UN model, there is no territorial extension. From entitlement to benefits, it comes to entry into force under Article 30, then finally to termination. So these are the differences between the contents of the OECD model and the UN model. We are not doing the US model, sorry. So those are the differences between the contents. Now we'll dive deeper into the various provisions and take it article after article.